Finance is a lifeblood of the business. Every business is running on the basis of only finance. Any organization goal is based on the principles whatever money have been utilized properly, the goals can be reached. Whatever the profit available, that should be maximized so that we can increase the wealth of the shareholder, and also the main objective of the company is like that. Every supplier require whatever the capital invested, they want a good return. Good return depends upon the efficient management. Hello, my dear students. I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidyashram First Grade College, a Temple of Excellence, Mysuru. Today, in this session, I am going to have Financial Management, 5th semester, Unit 1, Session 1, BCom, in favor of Introduction to Financial Management. This is Unit 1. We are going to say what are the theory says about the financial management. We'll move on to theory now. Finance, because we are going studying financial management. So first you have to understand what do you mean by finance. Finance is considered as the lifeblood of business. This is most important. So every business requires finance, which is the lifeblood of the business. Finance is the master key which provides access to all resources for being employed. Finance is the lifeblood of business. Without it, things would not run smoothly. It is the source to run any organization. It provides money and it acquires the money. So, finance is the lifeblood of the business. Every business is running on the basis of only finance. More finance, more expansion, less finance, less expansion. So, finance is the lifeblood of the business. Every organization requires the finance. Introduction to financial management. So, financial management main objective or goal is to maximize the shareholders' wealth. The major goal of this financial management is nothing but maximize the shareholders' wealth. It refers to effective management of money to reach the organizational goal. Any organizational goal is based on the principles whatever money have been utilized properly, the goals can be reached. Financial manager have to take financial decision. He will take effective decision to increase the wealth of the shareholder. So whatever the decision the financial manager take, it increase this is the most, he will take the effective decision to increase the wealth of the shareholder. The wealth of the shareholder depends upon the financial manager. The good decision makes the wealth of this decision increase the wealth of the shareholder. Financial manager think about the finance like how to borrow the fund, how to use the fund, and when to invest the fund. So, how to borrow the fund, how to use the fund, how to invest the fund so that the shareholder can be increased. In order to maintain the finance fund, we need management. We want a good management, good financial manager so that the finance of the shareholder wealth will be increased. So, financial management is very essential for effective management, controlling the funds and finance. So, effective management is most important in order to control the finance. So, objective or goals of financial management. Primary objective, maximization of shareholders' fund. The main intention of the firm is to maximize of shareholders' wealth. This is important. Shareholders' wealth should be increased. Higher the share price per share, the greater will be shareholders' wealth. If the share value increases, automatically the wealth of the shareholder also increases. Shareholder wealth can be calculated by multiplying the current share price with the number of shares owned by the shareholder. If the share value is rupees 100, if he got about 10 shares, 10 ones are 10 followed by 1000 B. So number of share multiply the price. More price, more wealth, less price, less wealth. Shareholder can be kept by multiplying the current share price with the number of share owned by the shareholder. Shareholder wealth, number of shares owned, current share price per share. The market price changes now, it fluctuates. More share value, more wealth, less share value, less sale. Depends upon the prices available in the market. Next, objectives or goals of financial management. Profit maximization. The main objective of the company is to maximization of shareholders' wealth. In order to maximize the shareholders' wealth, company needs to maximize its profit. The profit should be maximized. Whatever the profit available, that should be maximized so that we can increase the wealth of the shareholder. And also the main objective of the company is like that. Whatever the profit available, profit should be maximized to shareholders' wealth. Other objectives. Maintenance of adequate liquid asset in order to meet the short-term liability. The short-term liability can be met with the help of adequate liquid asset. Optimum utilization of the scarce resources. So you can utilize maximization of optimum utilization, minimization of cost and controlling cost. The most important cost control, we say less cost, more profit, more cost, less profit, depends upon the cost price. So you have to make the control of the cost so that the price of the article will come down and we can have the more profit. Ensuring the regular and sufficient supply of the capital to the business. So the capital means asset minus liability is equal to capital. The capital of the company, the money which is important, the capital of the business, sufficient supply of capital of the business. So ensuring regular, sufficient. If you want to improve the company's case, the capital is most important. Capital means asset minus liabilities. Ensuring the fair rate of return to the suppliers of capital. So every supplier require whatever the capital invested, they want a good return. Good return depends upon the efficient management. Ensuring the better utilizing capital by following the principles of liquidity, profitability, and safety. So whatever the money invested by the shareholder can be utilized so that they can get the maximization of profit. Coordinating activities of the finance department with those of the other department. Finance department should have a very good relationship so that with other department so that automatically the company will be developed. Function of the financial manager. The finance manager has to ensure organization efficiently through proper acquisition, allocation, and movement of the finance. So the main objective is how the finance should be bifurcated to different heads so that the company can develop. So all depends upon the financial manager. A good finance manager is a good planner, organizer, director, and controller of inflow and outflow of fund. The inflow, how much fund received, how much fund can be utilized, will be in the hands of the financial manager. A good financial manager know how to invest a fund, what time it should be invested a fund, what percentage he has to invest in the month of September, in the month of October, in the month of December, depends upon the demand he will invest. So inflow and outflow of the cash depends upon the financial manager, how he can control. So all the financial manager plays very, very important role in the development of the company. The shareholder wealth will be increase or decrease, depends upon the decision of the financial manager. He has to provide operational efficiency by providing timely supply of fund. Otherwise, organization, it will lose its goodwill and its position in the industry. Gradually, it will lead to its shutdown. So, a good financial manager should be put the money in such a way that so that the goodwill of the company should go. By chance, wrong decision taken by the financier will leads to the goodwill of the goodwill. It loses its goodwill. Gradually, it leads to shutdown of the company. The function finance. The following are the major function of the financial management. Financial management involves various activities of business like purchase, production, and marketing. So he has to involve himself in purchase of the article, production of the article, marketing of the article. He is also required to evaluate effectiveness of various financial decisions in the light of standard set. Whatever the standard set, for all the standard, he has to supply the finance. So proper finance in the proper planning will be help in development of the company. Business forecasting, determination of financial object, financial policies, and operation project. Correct financial policy should be implemented by the financial manager so that the goodwill of the company will increase. But a wrong decision of the financial manager will shut down the company, the goodwill of the company will go. Estimation of the capital requirement of the business, decision, capital structure, all depends upon the financial manager. So he plays very important role in the development of the company. One wrong decision of the financial manager will lose the goodwill of the company. Automatically the company will be shut down. Then bought the capital from the various sources. This is allocation of finance, control and management of funds, determination of proper source of finance, investment decision, disposal of surplus, management of cash, management of foreign exchange reserve. These are all the major functions he has to do it. The finance function is a part of financial management in business. The finance function involves the acquisition and utilization of funds necessary for the efficient of the object. In order to operate the operation, the more funds are required. He must know, as a financial manager, he must know how to borrow the fund, how to invest the fund, what time he has to borrow, what time he has to invest. The finance function is business refers to the function intended to acquire and manage financial resources of general profit. In order to arrive the profit, to get profit, it depends upon how the plan will be made by the financial manager. So all depends upon the financial manager idea. He must know that how to invest, what time you have to invest, how to borrow, what time this should be borrowed. Then only we can say that the development of the company. The four major types of financial decisions are investment, liquidity, financial, and dividend decision. Types of financial function. There are different classification of finance function and it varies with organization. Investment decision. The investment decision function revolves around capital budgeting. So how to invest is the most important decision of the financial manager. Capital budgeting is an organization involves in the analysis investment opportunity, especially long-term project, associate cash flows, determine the profit. So when you want to invest a long-term project, you must understand it may take 5 years, 4 years, 10 years, 11 years, 15 years. You must have an idea so that how the fund should be analyzed for this fund. Then financial, these are all the methods to follow making the investment decision to pay back the period. So following the decision to be taken, this is a technical decision we take. One is called accounting rate of return, net present value method, internal rate of return, profitability. For all these things, problems will be solved. Then finance decision. Financial function deals with acquiring the capital like when and how, the various way. The debt and equity mix of an entity are called its capital structure. So debt and equity, when you say capital structure, it requires equity share capital plus preference share capital plus debt value. The finance decision always focuses maintain the good capital structure ratio. Then expertise in forming the finance decision leads to optimize the capital structure, enhance the performance. So capital structure depends upon one capital that's called equity share capital plus preference share capital plus debt value. Then dividend decision. Company share profit with their shareholder in the form of dividend. How the dividend is paid? The total profit of the company minus expenditure divided by shareholder. First we'll give to preference shareholder, whatever the balance left over, divided by number of equity shareholder. When you earn the profit, out of the profit, all the expense will be deducted. Then the preference dividend will be given to preference shareholder, whatever the amount available, that is divided by number of equity shareholder. I'll repeat once again. the total profit of the company minus expenses, amount available. First, we'll give the preference to shareholder. Whatever available, that will be divided by number of equity shareholder. Further, company dividend policy influence the market value and stock price. So the price depends upon the market price available for the shareholder. Hence, dividend decision, including the division net income between dividend and retained earning, is an important function. Now, liquidity decision. Liquidity decision generally revolves around working capital decision and management. So, working capital, day-to-day working capital, day-to-day current asset minus current liabilities. The lack of liquidity results in issues like financial crisis and insolvency. At the same time, a lot of liquidity can also lead to more danger. Hence, it is important to have the right mix of current asset and current. So, it is in the hands of the financial manager how he can mix current assets and current liability. Current asset minus current liability is called positive working capital. Current liability minus current asset is called negative working capital. What is working capital? Current asset minus current liability. More current asset, less liability is called positive working capital. More liabilities, less current asset is negative working capital. So all these are in the hands of the financial manager. The organization of finance function refers how the company structure in financial operation includes the responsibility. The organization of financial function implies the division and classification of function. Finance, because of financial decision of the utmost significance to firm. Therefore, to perform the functions of finance, we need a sound and efficient organization. So, an efficient manager has to look after everything so that the company can develop. 5 critical functions of financial management: cash management, financial report. This is important. Cash management, financial reporting, financial control, risk management. Then, financial planning is the process that helps in managing the financial resource achieve the long-term, short-term goal. So, financial management plays an important role in order to arrive long-term financing. It helps in making information decision to allocate outcome. How to allocate the fund is the most important. Financial planning helps to keep our financial control achieve goals. The goals of the company depends upon how the financial manager take the decision. Financial planning is set up to meet the one's life goal. The goal of the company depends upon the finance in the hands of the financial manager. So he has to play an important role to achieve the goal. To understand more about the financial planning, let us take a closer look at these types: objective and important and benefits. Objective financial planning, preparing the budget to it fits for our financial plan, to determine current financial position, set up financial goals, set up financial plan, to review the financial plans you have got. Types of financial plan. Financial plan is done to achieve our future goals, including investment, tax saving, retirement, education. This is important. The basis of some of the common type of financial planning are invest planning, tax planning, budgeting, insure planning, education fund planning, estimate planning, wealth growth. These are the points to be remembered while you are writing about the financial planning. Then, benefit of financial, it will increase our saving, it will help to enhance our standard, it helps to prepare for emergencies, it helps to attain the peace of mind, and when we have sufficient money for our needy, it helps in calculating the right insurance cover, it helps in saving the tax. Success of the financial plan: understand our correct financial situation, most important. Write down our financial goal is most important to achieve. Look at the different investment options. What are the different options are available? Implement the right plan in the right place in the right time. Monitor our financial plan regularly. This is important. The importance of personal financial management, financial planning for life goal. It includes wealth creation, retirement planning, child education, and savings tax. Hope is a long process. So finance plays very important role in the development of the company. The goodwill of the company depends upon how the financial manager take the decision. So a good decision definitely help the manager. The shareholders' wealth will be increased. One wrong decision of the financial manager leads to the the goodwill of the company goes, automatically the company will be shut down. So all in the hands of the financial manager, how to utilize the fund, how to borrow the fund, what time he has to borrow fund, what time he has to invest the fund, what type he has to invest the fund, which type is most important. The goodwill of the company all depends upon the investment made by the financial manager. Hope you understand. It's a good thing for the year as a financial fifth semester student. It's very important to understand the financial manager. Hope you follow some of the important points which I have discussed. So we'll meet in the next session with a problem. Till then, goodbye. We'll meet in the next session with a problem. Goodbye.